Welcome to vTalkInsight, Market Drivers Daily for December 20th, 2025. AI, European war financing, and shifting growth signals are all moving today, reshaping how markets think about earnings, risk, and opportunity. Let's start with the AI story that is still setting the tone across assets. AI remains the dominant engine for markets, but the character of the trade is changing. The megacap tech platforms at the center of the story are still posting strong double-digit profit growth, with forecasts for these names being revised up even as expectation for the broader indices are nudged lower. At the same time, AI usage is climbing quickly, with adoption among adults and across the wider economy rising noticeably this year, and close to two-thirds of chief executives indicating they plan to lift AI spending. This combination of delivery on earnings and visible end demand keeps AI-related equities in the leadership seat, even as investors become more selective about where they take risk. Under the surface, the infrastructure build-out behind that earnings story is accelerating and spilling into the real economy. OpenAI's revenues are reported to have jumped from around the low single-digit billions last year to more than 3 times that level now, helping to justify large-scale data center expansion plans and ambitious funding targets. Oracle has committed to an exceptionally large pipeline of data center leases, positioning it as a high-profile proxy on AI infrastructure and as a key beneficiary of hosting deals, such as TikTok's move of U.S. user data onto its servers. AI-driven data centers and stationary storage are also expected to be major new sources of demand for copper, aluminum, and lithium next year, with AI alone projected to account for a substantial share of incremental copper demand growth. That links the AI theme directly to metals, power markets, and selected real estate and utility assets. The macro backdrop is being reshaped by AI-driven productivity gains, which are increasingly visible in the data. Measured productivity growth has averaged around 2% year-on-year over the past 3 years, roughly double the pace seen in the decade after the financial crisis. That improvement is one reason why U.S. growth is expected to slow only modestly this year and then re-accelerate toward the low 2% range next year, even as inflation pressures ease. For central banks, AI creates both opportunity and uncertainty. Stronger supply-side performance gives them more room to tolerate a hotter economy, but it also weakens traditional relationships between unemployment, output gaps, and inflation. Committee members are already diverging on estimates of the long-run policy rate, and AI-related supply shocks are a key part of that debate, setting the stage for more volatility as rate expectations shift. Against this backdrop, capital is still pouring into AI, but on terms that increasingly look stretched in parts of the ecosystem. Late-stage private AI companies are being valued at hefty premiums, with some estimates putting their worth at around 250% above comparable non-AI peers. OpenAI is reportedly exploring a funding round that could push its valuation toward the high hundreds of billions while aiming to raise up to $100 billion of fresh capital. Earlier stage examples, like Lovable's rapid move to a multi-billion valuation after a sharp increase in recurring revenue, underline the appetite for perceived category winners. Public markets are preparing for a wave of sizable AI and software as a service listings in 2026, including potential near trillion-dollar valuations, which will test how much issuance equity investors can absorb without forcing a repricing. The tension we highlighted earlier this week between robust economics and bubble risk is now sharper. Current demand for AI exposure is driven partly by fear of missing out, yet investors are already signaling that future funding and valuations will depend more on clear returns on investment. There is an expectation of a shakeout in which firms with proprietary data, vertical expertise, and strong infrastructure pull away, while others with weak monetization or heavy cash burn struggle as capital becomes more discriminating. Funding and capex needs at major players such as Oracle and OpenAI are another watch point, as concerns about liquidity or leverage could quickly spill back into equity sentiment. Regulatory and operational risks also loom, from AI systems that can be manipulated into loss-making decisions to security vulnerabilities and the challenge of governing autonomous agents and data access inside enterprises. Looking ahead, upcoming earnings from hyperscalers, the launch of new frontier models from OpenAI and Meta, and any shift in CapEx guidance will be key catalysts for the AI complex. How those events land will help determine whether recent consolidation in tech remains healthy rotation or evolves into a more damaging unwind, setting the stage for how geopolitics interacts with this technology cycle. Geopolitics is increasingly being expressed through balance sheets, and nowhere more clearly than in Europe's latest move on Ukraine funding. EU leaders have now agreed a roughly €90 billion support package for Ukraine, structured as a zero-interest loan over 2 years and financed through joint European borrowing rather than direct national budget transfers or an immediate seizure of frozen Russian assets. Earlier this week, the debate over whether to use those frozen assets was a key source of division. Today's compromise leans into shared debt while postponing the toughest legal and diplomatic choices. Repayment of the loan is explicitly tied to eventual Russian reparations or to the use of immobilized Russian assets, which shifts some credit risk away from individual member states, but embeds uncertainty over who ultimately bears the loss. This new Ukraine package deepens Europe's experiment with collective borrowing and raises important questions for sovereign risk and regional spreads. On the one hand, issuing joint debt to fund Kyiv's budget needs signals greater fiscal coordination and may support risk sentiment toward Europe in the near term, especially compared with a scenario of political deadlock. On the other hand, the package still falls short of estimated multi-year funding requirements, and it adds to the debt burdens of already highly indebted members such as France and Italy. Russia's warnings that any use of its frozen reserves would destabilize the global financial system and trigger legal action keep legal and reputational risks in focus. For investors, this means assessing not just headline debt levels, but also the evolving architecture of shared obligations and contingent liabilities inside the euro area. Beyond Europe, geopolitical tension is increasingly centered on technology, data, and capital flows between the United States and China. New U.S. legislation has expanded the government's authority to restrict American investment in Chinese technology companies, particularly those with dual commercial and military uses, moving beyond earlier executive actions. Export controls on advanced chips and manufacturing equipment are being handled separately from broader trade talks, underscoring that national security considerations now dominate technology policy. At the company level, the proposed TikTok U.S. structure, with American investors holding a majority stake and Oracle managing U.S. data and algorithm retraining, could ease some bilateral strain if fully approved. Signals from Chinese state media suggest cautious acceptance, but ByteDance retain minority stake and ongoing questions over long-term control mean regulatory risk is far from resolved. Energy and alternative stores of value are another arena where geopolitics is feeding directly into markets. Oil fundamentals still point to ample supply, with OPEC Plus pausing further production increases into the first quarter in response to oversupply and seasonally soft demand. Yet potential disruptions from Venezuela and Kazakhstan, combined with ongoing Russian flows and active U.S. sanctions policy, keep a risk premium in the system even as the medium-term price outlook remains capped. At the same time, gold and silver prices are trading near record levels, supported by expectations of rate cuts and strong central bank buying driven by sanctions risk and broader geopolitical uncertainty. Crypto markets are also in the crosshairs. North Korean hacking groups have been responsible for a large share of recent digital asset thefts, while state-backed instruments, such as Russia's ruble-linked stablecoin, have facilitated tens of billions of dollars of transactions, raising fresh questions about sanctions evasion and de-dollarization. For markets, these geopolitical trends point to a more fragmented and risk-aware global landscape rather than a single, dominant shock. In Europe, joint borrowing to fund Ukraine may support risk assets in the near term, but the unresolved questions around frozen Russian assets and the remaining funding gap leave scope for renewed tension. In U.S.-China relations, tighter controls on capital and technology exports, coupled with European regulatory pressure on large U.S. tech firms, increase uncertainty around earnings trajectories and business models for globally exposed platforms. Energy and safe haven assets will remain sensitive barometers. A significant escalation in sanctions or conflict could quickly tighten oil balances despite today's surplus, while continued central bank demand and political risk are likely to underpin gold even if the pace of gains slows. Key watch points now include any EU move toward actually deploying Russian assets, final decisions on the TikTok structure, the evolution of sanctions on Russian and Venezuelan energy, and how regulators respond to growing use of digital assets in cross-border finance. Those developments will help frame the macro environment into which the next phase of global growth is emerging. The growth narrative is tilting toward a soft landing that transitions into modest re-acceleration, but the drivers are shifting and the risks are nuanced. U.S. output is expected to slow to roughly the mid-1% range this year before rebounding toward around 2.25% next year, helped by AI investment, supportive financial conditions, and fiscal stimulus. Forecasts for S&P 500 earnings remain constructive, with double-digit growth penciled in for this year and next, and some houses projecting mid-teens, gains extending into 2026 and 2027. That backdrop supports the view that the current profit cycle still has room to run, even as markets grapple with changing leadership beneath the surface. Fiscal policy is an important part of the growth story, particularly in the U.S. and parts of Europe. In the U.S., fiscal measures are expected to add around 80 basis points to growth in 2026, concentrated in the first half of the year. Plans include sizable transfers to households, sizable incentives for corporate capital expenditure, and tariff-related refunds that together could amount to close to 1% of GDP, helping to cushion a soft labor market and support consumption. In Europe, a substantial German investment program worth well over 100 billion euros for 2026, embedded in a broader multi-year infrastructure push, is anticipated to give a notable boost to Eurozone activity. Implementation remains the key risk, but rising deficits already hint that government spending is starting to underpin momentum. Growth is also broadening across sectors and regions, creating more dispersion in equity performance. Recent earnings from travel and leisure names such as cruise operators, global hotel chains, and online accommodation platforms have surprised positively, pointing to resilient discretionary spending and robust demand for both leisure and business travel. Corporate travel specialists are reporting strong growth in bookings, revenue, and margins, helped by clients seeking AI-enabled tools to manage spend and productivity. Consumer-facing trends are mixed, but include bright spots. Non-alcoholic beverages, including alcohol-free beer and wine, are seeing rapid expansion, while coconut water continues to benefit from tariff relief and demand for functional drinks. Retailers are capitalizing on omnichannel habits, with some seeing the majority of online orders fulfilled through in-store pickup or drive-up services. Internationally, leadership is shifting in ways that matter for asset allocation. Emerging markets have outpaced developed peers this year, delivering returns roughly double those of the S&P 500 on the back of improving fundamentals, more favorable capital flows, and still appealing valuations. Countries like Poland stand out within Europe, combining 3 to 4% growth, substantial EU-funded infrastructure spending, and policies designed to pull household savings from deposits into equities, supporting local market development. China is expected to beat conservative growth forecasts on the strength of exports, even as weak domestic demand remains a headwind for European companies with heavy China exposure. Looking ahead, European manufacturing is projected to recover by 2026 as capex stays elevated, household savings remain solid, and monetary policy gradually eases, which could support higher commodity prices and demand for industrial metals already being lifted by AI infrastructure and construction. Beneath the upbeat narrative, several risks could complicate the growth picture. A marked slowdown in U.S. consumer spending is anticipated next year, raising the question of how far AI investment and energy infrastructure, which account for a smaller share of GDP, can offset softer consumption and potentially less supportive government outlays. There is also a non-trivial risk of stagflation in 2026 if AI-driven gains disappoint or if data center capex slows, while fiscal support and other supply constraints keep inflation elevated. Policy divergence adds another layer. The European Central Bank is signaling that its rate-cutting cycle may already be complete given resilient growth and sticky services inflation, while Japan's central bank is expected to normalize policy more forcefully as fiscal stimulus and persistent inflation push rates higher than markets have priced. These dynamics influence yield curves, currency moves, and relative performance between large caps, which currently dominate leadership, and mid and small caps that are expected to benefit more as easing progresses and merger activity picks up. Putting this together, markets are leaning toward a scenario where growth slows but avoids recession, then re-accelerates into 2026 with greater regional and sectoral dispersion. AI-driven productivity, targeted fiscal support, and resilient services demand underpin the constructive case, while high valuations, consumer fatigue, and policy uncertainty limit the margin for error. Key indicators to watch from here include productivity and wage data, European manufacturing surveys, earnings across travel, consumer, and industrial names, and capital flows into emerging markets and smaller caps. How these data evolve will determine whether today's supportive narrative holds, or whether macro and geopolitical shocks force a sharper repricing across assets. To wrap up, AI remains the core driver of earnings and productivity, but stretched late-stage valuations, heavy funding needs, and growing policy uncertainty are pushing the market into a more selective phase. Europe's new Ukraine loan package shows fiscal integration moving ahead, yet unresolved questions over frozen Russian assets, energy sanctions, and U.S.-China tech frictions keep geopolitical risk firmly in play. At the same time, the growth backdrop still points toward a soft landing with pockets of re-acceleration, supported by targeted fiscal measures, services strength, and emerging market resilience, even as consumer slowdown and inflation risks loom. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.